The Noon Business Hour is presented by the Village of Bedford Park. Stocks are a little bit higher today. Let's find out what's going on. John Bever is joining us, president of Phase 3 Advisory Services, registered principal with Royal Alliance Associates based in Buffalo Grove. John, as you're looking around Wall Street today, what do you make of what you're seeing?
Well, Cisco, it looks like the market this morning has digested Uber and Uber Eats and the ISM report, services report, and yesterday's new high, and is just kind of sitting back and relaxing. No other significant news today. So what I see is a broadening rally, which is good, perhaps some sector rotation, encouraging China trade, and lots of liquidity still from central bankers around the world.
How challenging is it, since this trade war has gone on for so long, we really don't know how it's going to end or when it's going to end. How difficult is it for investors to really chart a path forward?
I don't think it's too difficult now because we've gotten used to all the news going back and forth. And actually, there's some positive news here. Looks like we're going to have maybe like a two-phase détente here where we've got some tariffs perhaps rolling off in December 15th. Already some September tariffs have been rolled off. I think we'll continue to see some of this back and forth action, but investors are getting used to this. And remember, we've known all along China has a lot more to lose than we do, so there will be a deal at some point in time, and it looks like the talk of compromise is coming in here. So I think it's becoming less and less of an issue, which is supportive to the U.S. market.
And so as far as the markets are concerned, unless there's a trade deal that's really skewed one way or another, really highly, you're not going to really see it influence the markets much.
No, I don't think so. And I think what we're seeing today is indicating that. You know, we're digesting the highs of yesterday, very normal fashion. We had that high yesterday, that new high, which is a 5-month high, breaking the July high. We've gotten that on higher volume. Today, we even have a little bit higher volume, which is good. All three indices broke new highs yesterday. We've got a little bit of normal profit-taking that took place this morning. Transports are on the verge of a new high, which confirms Dow theory rally. We've got over 150 S&P stocks within 2 to 3% of new highs. So this rally is really broadening out. The defensive sectors of utilities and real estate and staples are in retreat. So this all looks very good. I think that investors are normally digesting this and are really starting to pay less attention to what's going on in the trade unless, like you said, we get some kind of a crazy skewed deal one way or another. I don't think it's any news anymore.
Everyone just keeps saying, though, the expansion, it just can't keep going. It has to end sometime. And so they're almost encouraging people to develop more of a defensive posture. The fact is we just don't know when it might end.
No, and what I'd like to see this healthy skepticism out there. That's always good. It means there's probably more room to go. You know, it's been 10.5 years now that this rally has been going. We've had a nice long expansion, but it hasn't overheated. I think we're a ways from overheating. We've got the Fed now helping us out, which is also a good thing. So I think we've got a good situation unless some kind of surprise comes in, which can always happen, but I don't think that will happen. The environment this quarter, fourth quarter, is also very different than the environment we had a year ago at this point in time, and people are still feeling the sting of what happened last year in the fourth quarter. So again, there's some healthy skepticism out there.
How's Wall Street feeling about the Fed? Not only what the Fed is doing, but what the Fed is saying.
Yeah, they like it. They're applauding it. So the Fed was too restrictive last year. Chairman Powell was saying that they're going to hold quantitative easing on autopilot, and of course he reversed course after the Christmas Eve correction, and since then has lowered rates 3 times, and now they're just on hold, which is good. The market seems to be priced well at a P/E ratio of 18, and the Fed seems to have settled in here. Perhaps Chairman Powell has found his place now, and what's good about this is that they're not talking about taking away any more liquidity at this point in time. Now, the problem is there's a lot of liquidity out there sloshing around still, about $4 trillion from our Fed, and then we have other central bankers around the world that are still engaging in quantitative easing, but this is at least good for the market. So I think we've still got a ways to run here. I'm thinking this is kind of like what we're experiencing in Chicago right now in the fall. We've got a pleasant, kind of cool day right here. We haven't had Indian summer yet, so I'm thinking we may get one more push to the upside, one more good rally out of this market within the next 12 months.
A lot of people focus on U.S. companies, which makes a lot of sense. Anything maybe internationally, or at least in general, should that be something that people are paying attention to?
We have been buying international this last year, and it actually looks like in the last month we're starting to see this swing. There's about a 10-year pendulum swing back and forth where international wins and then U.S. wins, and we're talking about the stock trading of the companies and the interest in those companies. So the last 10 years has been a win for the U.S., and now it looks like we're starting to see that turn back to international. PE ratios on the S&P 500 about 18, internationally around 12 to 13. So certainly we are not at parity here. This could result in as much as a 25 or 30% rally of international over the U.S. maybe over the next 5 years. So definitely I would be overweighting international. If you're not overweight yet, I would take these rallies as an opportunity to lower U.S. equities and increase international equities.
We touch on this dollar cost averaging. We touch on that a lot. Is it maybe a time to remind people of that in a market that you get a few ups, few downs, but really no significant movement?
Always dollar cost average. The market is always going to be volatile. When we take a look at history, I can't find a period of time where the market isn't volatile. In fact, what's unusual is the last 10 years have been less volatile than normal. So dollar cost averaging, by far, one of the best ways to invest, not only in U.S. equities, but it's a great way to get that exposure to international equities. So rather than trying to time the market and pick that place to just extremely overweight international, I would continue to dollar cost average. That's every month. Put in a fixed dollar amount, come rain or come shine. Don't get scared. Don't get greedy. Just keep setting that money in there every month.
Thanks so much for all the analysis. John Bever, president of Phase 3 Advisory Services.